Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to a brand new week. I hope you enjoyed the long weekend. This is Peter Lewis with Money Talk on Monday the 29th of May. This podcast is available on Apple Podcasts, Google Podcasts and Spotify. Just search for Peter Lewis's Money Talk in your favourite podcast app, or go to my website, peterlewismoneytalk.substack.com, and follow one of the links there. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, White House and Republican negotiators reached a tentative deal late Saturday to raise the US debt ceiling and avert a default. The deal includes a 2-year debt limit increase and a 2-year agreement that keeps non-defence spending roughly flat with current levels, while increasing it by 1% in 2025, with no further caps after that. Republicans had initially pushed for deeper spending cuts over a decade. US inflation and consumer spending accelerated last month, increasing the chances of another interest rate hike next month. The Personal Consumption Expenditures Price Index, which measures how much consumers pay for goods and services, and a core measure that excludes food and energy, both exceeded estimates. The core PCE index, which is the Fed's preferred inflation gauge, unexpectedly jumped to 4.7% year-on-year last month from 4.6% in March. The Commerce Department's data also surprised economists with the strongest gain in household spending since the start of the year. Profits at industrial firms in China fell in the first 4 months of the year on cooling demand, deepening factory gate deflation and margin pressures. Profits earned by China's industrial firms dropped by 20.6% from a year earlier in the first 4 months of 2023. The decline followed a 21.4% plunge in the prior period and a 4% fall in the whole of 2022, with profits shrinking in both state-owned firms and the private sector. US Secretary of Commerce Gina Raimondo met her Chinese counterpart Wang Wentao Friday. She discussed concerns on recent actions taken on American companies operating in China. Mr. Wang raised concerns about US export controls in areas such as semiconductors, as well as a proposal to review outbound investments for security purposes. Mr. Wang is expected to meet US Trade Representative Catherine Tai in the coming days. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Sunil Kashyap, Director of Finmet. And with a view from mainland China is Ben Cavender, Managing Director at the China Market Research Group.
Peter Lewis's Money Talk.
US stocks hit a 9-month high on Friday, propelled by solid economic data and a rally in technology shares. The S&P 500 advanced 1.3% to end the session at 4,205. That's its highest level since mid-August. For the week, the benchmark index gained 0.33%, notching its second straight week of gains. The Dow rose 329 points, or 1%, to 33,093. Over the 5 trading days, it dropped 1%. The tech-heavy Nasdaq Composite led the way, gaining 2.2% to 12,976, boosted by a rally in artificial intelligence-related stocks. The Nasdaq, which is off to its best start in more than 30 years, rose 2.5% for the week, its 5th consecutive week of gains. The advance was led by shares in computer chip design and Nvidia, which jumped last week to take the company's valuation close to the $1 trillion mark. On Thursday, Nvidia soared 25% to an all-time high, adding just under $200 billion in market cap, boosted by chips that are driving the artificial intelligence revolution. And that is the largest single-day market cap gain for any stock in US equity market history. From the October 2022 lows, Nvidia has risen now more than threefold, adding $665 billion in market cap, and its shares are up nearly 160% this year alone, putting it on the cusp of becoming the first $1 trillion chip company. Last week's surge was sparked by its latest quarterly results. The company said it was raising production of chips to meet surging demand as the AI boom translated into record sales. And excitement that the new era in computing is kicking in faster than previously thought sent chip stocks around the world soaring. Taiwan Semiconductor Manufacturing, which makes Nvidia's chips, rose over 14% in US trading on Thursday and Friday. Equipment supplier Advantest surged over 21% to an all-time high in Tokyo over the same over the same period, while Hynix advanced almost 12% in Seoul in just 2 days. And in Europe, semiconductor stocks, ASML jumped almost 10% since Nvidia's results, and BE Semiconductor Industries nearly 12%. Chinese stocks hovered around a 5-month low. The CSI 300 index of the largest companies listed in Shanghai and Shenzhen was down 2.4% last week. And heading towards a fourth straight losing month, the benchmark has slipped 8.4% from its peak now at the end of January, wiping out $1 trillion in value from domestic A shares. Hong Kong markets were closed for a public holiday. Last week, the Hang Seng Index fell 3.6% over the 4 trading days, and futures markets are pointing to a gain of around 100 points in the Hang Seng this morning. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have our regular Monday morning commentator, Alex Wong, director at Alex K.Y. Wong Asset Management. Morning, Alex.
Hi, morning, Peter.
And also with us, Sunil Kashyap, who is director of Finmet. Morning, Sunil.
Good morning.
Let's start with this debt default deal. White House and Republican negotiators have reached a tentative deal to raise the US debt ceiling and avert a default that threatened to derail the US economy and send tremors through global financial markets. Speaker Kevin McCarthy said the deal included historic reductions in spending and that he planned to have it ready for a vote in the House on Wednesday. President Joe Biden said it represents a compromise, which means not everyone gets what they want. And the deal includes a 2-year debt limit increase and a 2-year agreement that keeps non-defence spending roughly flat with current levels while increasing it by 1% in 2025 with no further caps after that. Republicans had initially pushed for larger cuts over a decade, and the agreement doesn't create work requirements for Medicaid recipients, which was a key sticking point between the two sides. Alex and Sunil, the deal reached, but I suspect this is not the end of the matter, is it?
I think, of course, it will continuously have talks over the debt limit later on. But in the meantime, I think this is over. I think, and the market actually expected that. So probably people would put this aside and focus on other things right now.
Yeah, I think it's not done right now because the Congress still needs to approve it and it has to go through the process. So you'll still have a situation where some of the hardliners could, for example, stick to their demands and it goes into a war. But I think overall, it's like the market expected. We go through this drama every few years and ultimately it gets done. It has to get done. So that's what's going to happen and the markets are going to look beyond it.
So do you think, particularly in the bond markets, that's where we've seen the stress, isn't it? We've seen short-term Treasury bills recently hit a yield of 7%. I think that was an all-time high on them. Does this mean now that that's all going to get unwound over the coming days now and bond markets are going to return back to normal?
I think the fear of default will go. Maybe during the Congress posturing, it may fluctuate a bit, but once the vote is all done and dusted before June 5th, I think it'll be over. But the concern of inflation will still remain. So I think bonds are still going to be a little bit under pressure.
Alex, well, I suppose one of the things, though, that even if this deal is over, even if it gets passed, there are some things that are going to happen now, aren't there? Because the Treasury's virtually run out of money. It's got $39 billion. That's the lowest level since 2017. It's got to replenish its coffers, hasn't it? So that means large sales of Treasury bills, which is going to suck quite a lot of liquidity out of the market, just when the Fed has been rapidly raising interest rates. Presumably, there are going to be some consequences from this.
Yeah, that means the bond market actually would not have much rebound. I think the rates probably will stay a little bit high, and given the latest round of inflation data, actually, I think the market would expect the rates to stay high.
Let's suppose that the Treasury does run out of cash. Let's suppose there's a delay in this vote because there are hardliners who are threatening to try and derail it all. It's going to need votes from both sides. What happens then if there's a default? We heard last week Moody's warning that if the Treasury does miss this interest payment, then it's going to cost the US its AAA grade rating. How significant would that be?
I think we had something similar in 2011 where you went over the brink for a day or two and then sanity gets resumed. So I think that's what's going to happen now.
But Moody's this time around is talking about it won't be the AAA rating gets downgraded and then it bounces back afterwards. They're going to keep it at this lower notch now. Until, because they'll say this could go on again and again in future years. So this means the US could lose its credit rating for quite a while.
Well, I think probably the market actually has nowhere to go other than the US Treasuries. So I think it will not have that kind of impact, I think, yeah.
Likewise, I think I think commentators like to talk about doomsday scenarios, etc., but it's unlikely.
So you don't think you're pretty confident? It sounds like it that we're not going to see this big shock to global financial markets. That this is really done. Put that out of the way.
I think there'll be lots of drama on the way, but ultimately we'll get there.
Do you do anything, Alex, with your portfolio to prepare for a possibility that the US could default? Is there anything you can do about it, or do you just sit tight and assume it's not going to happen?
Actually, the only thing you can do probably is buy some gold on the current dips. So this is just a safe measures to do. So since it has come down so much, I think which you can buy some gold on current dip as insurance.
Okay.
Yeah.
Now, what about inflation? We had some data from the US on Friday about the core personal consumption expenditure. That's the Fed's preferred rate of inflation. Both US inflation and consumer spending accelerated last year. The PC index increased 0.4% month on month after rising 0.1% in March. Prices for goods increased 0.3%. Services inflation accelerated to 0.4%. And the core PCE index, which is the one that the Fed watches, rose 0.4% in April, ahead of March's 0.3% increase. And on an annualized basis, it rose to 4.7% last month from 4.6% in March. Not much sign there that inflation is coming down, is there?
No, there isn't. I think one thing to remember is the equity markets, which form largest part of the financial markets. In these equity markets, people want lower interest rates because the valuations go higher. So you saw the similar situation last year when the Fed was talking about transitory inflation, and all the commentators were saying yes, inflation is not going to rise. And so you have a similar thing playing out where everyone is looking for a pivot in interest rates, so they want to believe that inflation will come down. But it's not happening. The data doesn't show it yet.
Yeah. Is it worrying, Alex? It's really quite sticky, isn't it? And also the core number suggests that maybe inflation is starting to become embedded in people's minds. They are expecting price rises.
Yeah, I think this is a little bit worrying because it has not come down, even as commodities come down. So that means that something actually was wrong structurally. So I think this is a bit worrying in the long term.
Yeah. What's happening is wages are going up. People have more money. They're spending. So what the best likely situation may be that once you get to the summer, people start saying, okay, I need to save up again, and then stop spending because they're worried about inflation in the future. But right now, they're worried about recession in the future. But right now, what you have is a situation where people are spending, their salaries going up, they're spending, so that cycle of inflation is going through.
And we're seeing personal spending in the US, the highest level of the year, jumped 0.8% month on month. What was interesting was the things they were spending on, like healthcare, for example, and insurance. It sort of suggests that the psyche of the consumer has changed, particularly post-COVID, that has become more concerned about things like healthcare, like having proper insurance, and maybe are more interested in things like that than necessarily buying luxury items or big-ticket items.
That's right. And more importantly, these are price inelastic. So even when prices go up, you still buy insurance. So you have a situation where it creates that stickiness of inflation because people will still buy even though the prices are higher.
Alex, what does the Fed do?
I think we probably may still see one or two more rate hikes in the near future. Yeah.
But they will pause. I mean, I believe that the next month they will pause and let the market do its thing and see whether there is a reduction in inflation again. So they'll give it a month or two. But if it doesn't happen, I think they'll come back forcefully.
The policymakers on the FOMC seem quite divided, though, don't they, about this, about whether to pause or not. We had some comments last week from various policymakers, some of whom were saying exactly that we need some time now to assess. Others were saying, nope, inflation is just not coming down enough. We've got to keep on going.
But they are all unanimous that they will increase rates if inflation remains.
So, the other thing that's happening is the markets are also repricing the chances of a rate cut or several rate cuts by the end of the year. They were initially talking about 3 25 basis point rate cuts by the end of the year. That's virtually been completely priced out now. But presumably that's because it was just unrealistic in the first place, wasn't it? That was never going to happen, and certainly not if you believe the Fed.
Yeah, I think, of course, this is more difficult now because of the stickiness of the inflation. But I think this does not affect the market right now because the expectation for AI growth actually is so high. So it trumps everything, actually.
Yeah, people were hoping that somehow inflation would come down so soon, just like they were last year, and it didn't happen.
I want to switch attention to the equity markets. We've got this almost euphoric rally going on now in artificial intelligence stocks. We saw that with NVIDIA. It's almost become worth $1 trillion now, which added $200 billion in just 2 days. That's the biggest increase in market cap on record. It was all sparked by their earnings, where they say that there was increasing demand for AI-related chips. Alex, how real is this? Is this going to be the next now big theme in markets? I heard one analyst describe it as a new gold rush with NVIDIA selling all the picks and shovels. Is that where we're at?
Yeah, right. We are now at this kind of fever, and I think this is just getting more crazier. I think probably we would continue to see this kind of strength in the market. But since we probably are expecting the inflation to remain sticky. So other than the tech parts of the market, actually other segments probably may be remaining a little bit weak. So we would see a very big polarization in the global market. So AI-related themes actually would remain strong, but other things probably a little bit weak. So we probably may see weakness in the financial sectors and other things related to China consumption probably. So I think we will see a bull market and bear market to occur simultaneously.
Yeah, I am very skeptical about this. Yeah, I think it's a great technology, but it reminds me very much of what happened about metaverse a couple of years ago. Everyone was talking about metaverse, and there was so much money going into it, and Facebook decided to commit $10 billion, and then you had this big surge in metaverse stocks, and then what happened is people just lost interest because the dream was great, but the delivery was very slow. And I think the same situation may arise with AI. It's a great technology. It has huge potential, but these things take years to come to fruition. And the market is, I think, pricing in the most positive scenario of it happening within a few weeks. And I think there's going to be a realization later. I think also this is driven by the fact that there's no real good stories out there. So the bulls need a good story, and then everyone's rushing into AI. If you look at actual earnings of companies, it's pretty flat, and so that's why this is people are latching onto this feel-good story.
I never really understood the metaverse, what it was, how it was going to help me, but I do get AI and ChatGPT and things like that. I can understand how they're going to help. Jensen Huang, he's the co-founder and CEO of NVIDIA. He's in Taipei at the moment, and he was speaking at the University of Taiwan. He's basically saying that this new technology is going to transform the corporate landscape. He said AI is going to create new jobs, but make others obsolete. And he said firms and individuals should familiarize themselves with artificial intelligence or risk losing out, according to Mr. Huang. Do you agree with that, Alex? Is that where we're at? This is basically a new technology in something along the lines of maybe the mobile phone or the internet that's going to completely transform the landscape? Yeah,
I think of course it'll take years. So right now people probably are focusing on the stories and not about the business model. So this probably may create something like a very big bubble in the meantime. So I think this will continue to to play out, because this is a more solid story than the metaverse. So we probably may continue to see the fund inflow into this sector, and then actually the market like good story as right now we are talking about the recession risk in the world.
So yeah, I mean, I just use your analogy, Peter, like you said about picks and shovels. I think the first person who makes picks and shovels makes some money, but then people follow very soon. So the real people who make money are the people who discover the gold. So at the end of the day, I think the people who use that AI, who are able to harness the strength of AI, the power of AI, are the ones who are going to benefit.
So is NVIDIA unique then? Because it just dominates the market, doesn't it, for chips in that AI sector? It's got this huge lead over its rivals. Is NVIDIA in the situation where it's the only one, or are other chip companies going to catch up?
I think currently this is quite unique, and probably it will benefit other segments like TSMC or ASML. But in the meantime, probably NVIDIA would still be the most priciest one.
But presumably you can invest in other things as well, can't you? If you want to follow the AI trend, it doesn't just have to be chips. You could invest in some of the software companies, some of the cloud storage companies, the firms that make servers and routers. Are they all going to be beneficiaries of this? Yeah,
they are actually rallying. If you look at Oracle, actually, it's making new high right now. So we are talking about the cloud computing companies right now already. So I think this probably may be another theme right now.
And what about firms like Taiwan Semiconductor? They make basically the chips that NVIDIA needs, don't they? Is this going to be a big boost to them as well?
Of course, yeah. This is also, they are quite unique in terms of manufacturing capabilities. So I think that this is also another beneficiary.
But presumably we've got regulation on the horizon. That's what a lot of firms and regulators are talking about. This needs to be regulated in some way. Even people who are in the industry are saying that. Presumably that's going to be the risk to this boom in this segment.
I think it'll be a risk in terms of the rate of growth. So maybe the growth may take time because it's going to be more measured. But the fact is that over the long term, regulation will be good for the industry because it'll make people focus towards the positive aspects of AI rather than negative ones.
Well, where does China fit into this, Alex? Can China make these types of chips itself, or is it also sort of behind?
I think the market actually is a walk on no confidence right now, because if you look at the chip sectors in China, actually they lag a lot behind the overseas peer. So the market actually is a bit worrying about the growth, and actually the whole market actually is lagging behind because of the market no trust on China development of AI.
I mean, the Jensen Huang was talking about that last week, saying that basically this chip war with China is risking enormous damage to the US tech sector. He did an interview with the Financial Times last week, and he said these export controls leave them with their hands behind their back, and what China will eventually do is it will just make the chips itself and catch up.
But I think the market expects China to take long time to catch up, I think, because this is advancing so fast. So I think market actually is not believing that China will catch up in no time. So I think that's why the market actually does not like the China play right now.
Yeah, I think geopolitics is playing a big role. I mean, what's happened is that in order to make these chips, you need a particular kind of equipment, and a lot of that equipment is made in the West, in Europe, for example, in the Netherlands. And so using its power, the US is trying to avoid, to stop those exports of equipment from Europe to China.
I mean, this tech war, is it getting out of hand? Because we've now got China retaliating against Micron, for example. The US says that's not acceptable, although I find it a little bit strange. The US, on the one hand, says it doesn't want to sell high-tech equipment to China, so China says, OK, we'll ban it then, and now they're upset about it. It seems to all be getting completely out of hand, doesn't it?
So I think this is not good for China, because actually I think China is the one to hurt.
Really?
Yeah. And it's inevitable. I mean, so you're right, because China still needs the basic technology to get up to that level, to scale up. And so by, with this issue, I mean, in a way they don't have a choice. They have to retaliate. But it is a difficult situation where China was just ramping up its capability, and it's been stopped.
And it's sort of shot itself in the foot in the process.
It's reacted from a geopolitics way correctly, but then economically it's going to suffer.
Well, what about Chinese stocks? They're hovering around a 5-month low now. A lot of focus on the sluggish economic recovery, also the geopolitical issues. The Shanghai Composite had 3 straight days of losses and is down 2.2% over the week to a 5-month low. The CSI 300 index, which is the largest companies listed in Shanghai and Shenzhen, that was down 2.4% last week and is heading towards its 4th straight losing month. The benchmark slipped now 8.4%. From its peak in January, wiping out all its gains for the year. What's gone wrong, Alex? We had a good rally, didn't we, really, into the beginning of the year, which started about September, October time on the hopes of China reopening, and that's all been given back now.
Yeah, I think that the most worrying part of this current decline is this decline in the consumption sectors. If you look at leading ANTA shares in Hong Kong, actually they are so weak. I think people are now derating the consumption sector in China because of the disappointments on the China consumption markets. Actually, we are seeing weakness in overseas market companies doing business in China as well. If you look at Nike, actually it's a decline over 10% this month. So I think the market actually is now a bit worrying about the consumption spending in China. So this is the most worrying part because in the past we are seeing weakness in the tech sectors already because of the regulatory risk. But I think people are a little bit optimistic towards the China consumption story. But right now I think they have completely changed the stance and we are seeing that derating. And actually they are pricier than overseas companies because of the growth prospects. So right now probably we may continue to see this kind of devaluation. So that would mean quite a lot of trouble ahead in China market.
Really? So you don't think this is fully priced in, even though there's been a lot of focus on the weakness in the consumption sector? We've had plenty of data now, haven't we? Retail sales and so on. You don't think this is fully priced in yet?
Yeah, I think we probably may continue to see devaluation because if you look at the tech sector, actually the devaluation is so strong in Alibaba and other things. And right now we are seeing devaluation in the consumption sectors. So they probably may come down another 4 to 5 points in PE multiples because of the worry, and they are actually more pricier than overseas peer in the past. So I think this is something we need to look in China market right now because right now actually it is only supported by SOE. So people actually have nowhere to go other than SOE in China right now. So the consumption sector actually is a bit worrying to me.
So yeah, I think what we have in China is a crisis of confidence. If you talk to people, you find that amongst the private sector, there is a sense of uncertainty about what the government expects from them. And whether they can deliver what the government expects from them. And the second is the consumer confidence is not that high. I think they've been through such a difficult time because of COVID, and the sudden change in policies there leaves them a bit perplexed about what the future holds. So that's what you're seeing played out in the markets.
Alex, though, if you're talking about a 4 to 5 times re-rating on the multiple, I don't know what that translates into percentage declines, but that's quite big, isn't it? If we've got to shave off another 4 to 5 times earnings.
Yeah, it is already happening, actually. If you look at Leaning and look at ANTA, they are already having that kind of decline. So we probably may still continue to see that because they are not too cheap, and they are not having the power to compete in the global market. Actually, they are quite very focusing on the local market. So that is a bit worrying to me.
And what about foreigners? They seem to be very underweight now, don't they? They sold about $18 billion yuan of shares last week. That's about $2.5 billion. They've sold about 27 billion during the first 3 months of the year. They must be getting to the point now where they are extremely underweight.
Yeah, right. So we may see some kind of snapback rally later on because of this, but I don't think that would means a reversal. So we probably may see some kind of snapback rally later on because foreigners actually have all gone. So Chinese are actually dominating the market, but I don't think any kind of rally probably would propel into a sustainable one.
You're quite bearish. This is quite a bearish call, Alex.
Yeah, actually, if you look at the market right now, actually it's quite bearish because in the world, actually the market are supported by the AI concept. But in China, it is probably the only market which lack this kind of expectation. So that's why China probably will underperform the other part of the world.
And do you think there'll be some policy support? Could there be interest rate cuts, RRR cuts, something like that, to try and help boost the markets?
Yeah, I think so. But that probably may just give some short-term support only. Because what happened in China actually is a confidence issue. So young people actually are feeling lost, and they are not getting married, or the birth rate actually is really low, and the marriage rate actually is really low right now. So I think the problem is lying long term. So this I think is a quite big problem right now.
And when you've got a youth unemployment rate of 1 in 5 people, 20% out of work, it's not surprising, really, is it? I suppose that the people are not feeling very confident or cheerful.
Yeah, right. I think you cannot expect the market, the government to do everything right now because this is not helping the psychology of the consumer or the young people right now because the competition actually is really high and they probably are feeling very lost. So this is translating into their behavior.
Sunil, are you expecting some policy support from the mainland?
I think there is one potential upside, which is, there are ongoing talks between the US and China. So you may have a situation where the Chinese side is incentivized right now to try and see whether they can rebalance the current environment and just tone down the level of stress, level of tension between the two countries. And if you start seeing signals of that and there's more sort of cooperation being done in the future, then I think the markets may be seeing a positive move.
Alex, how much is the rally in other markets around the region sucking money out of China? For example, Japan, where we're seeing it now, the Nikkei went above 31,000 last week. That was, back to 1990 levels. Is that draining money also from China?
Yeah, I think so, because right now, if you want to play into China stories, actually you can also play into Japan, because many Japanese companies actually operate in China, and they are more aggressive than before. Even if you in Hong Kong, you can see a lot of Japanese companies expanding in Hong Kong to try to test the waters for the China market. So if you want to play, you can go into Japan to try to get a grab of China consumption market as well. So that's why I think people probably would feel it safer because they are global play and they have they can compete in the global market right now. But for Chinese brand, actually only a few can play. If you look at the tech sector, probably the only one you can get through is a PDD right now, because it's a very strong app in the US. But other things, actually, they are quite localized. So I think that's why people probably would go into other markets to try to get the China consumption story.
Well, thank you both very much. You heard there Alex Wong, Director at Alex KY Wong Asset Management, Sunil Kashyap, who is Director of Finmet.
Money Talk.
I'm joined now by Ben Cavender, who is Managing Director of the China Market Research Group up in Shanghai. Morning, Ben.
Good morning.
I wanted to ask you what's gone wrong for Chinese stocks with the CSI 300, the Shanghai Composite, now down at a 5-month low, wiped out all the gains that we've seen from the low of the year, and also coming close to wiping out that rally that we saw from about September, October time last year.
Yeah, I think if you go back a few months, there were a lot of investors that thought perhaps the recovery in China was going to go reasonably well, and I think you started to see money coming back into the market here, sort of hoping for that recovery story to be quite good. And in reality, I think what we've seen is while the economy is improving, it's still very hit or miss depending on the sector, depending on the region within China. And so the numbers just aren't that good, and they don't warrant the strong gains that investors feel they need to get. And so I think that's why you're seeing the exodus right now.
Is this a consumption story that, consumption just isn't holding up in the way that people had hoped after the reopening?
Yeah, I think there are a couple of parts to it. I think definitely on the consumption side, consumers are still very, very cautious about the economy. I think that COVID was a reality check for a lot of people in terms of them having to maybe dip into their savings and use those to kind of cover their daily life. And so I think people are quite a bit more hesitant to spend, especially on big ticket purchases right now. At the same time, if you look at the workforce, traditionally have been big consumers, sort of younger Chinese in their early 20s. It's a pretty sort of concerning story right now, I would say, for employment. The unemployment numbers that just came out have kind of continued to get worse. And so I think you just have a lot of people buckling down right now. And then on the supply side, the reality is that factory owners are not getting the orders they'd like to be getting, either for domestic manufacturing and sales or for exports. And so I think that that's also really creating a bit of a drag on the economy right now.
I presume you mentioned those numbers, youth unemployment, 1 in 5 people now under the age of 26 are unemployed, 20%. That presumably is a big drag on the economy and also just on sentiment overall. It's hard to be cheerful, isn't it, when there's that number of people, young people without a job?
Yeah, it's a big drag on the economy. And then from a sentiment standpoint, I think there's an additional challenge, which is most of these youth who are unemployed are, in fact, college graduates. And so I think there's a bit of a sentiment right now that perhaps the government has not been doing enough in terms of job creation of high quality jobs. And so you have a lot of people now entering the workforce who are taking a sit and wait approach because they don't want to go into a job that, in a sense, underemploys them. And so that's a really big problem that's quite difficult to solve.
And really, the government's done worse than that, hasn't it? It's not just not created jobs, it's destroyed jobs. If you look at what's happened to the online education sector, which is pretty well wiped out overnight, a lot of graduates would go into companies like that.
Yeah, and this goes back to the sentiment question for investors and sort of how investable China really is as a market, because I think right now there are a lot of sectors that investors might normally be interested in, and they just don't have a clear understanding of whether there will be government support for those sectors, whether there's going to be heavy regulation, whether all of a sudden, like the education sector, certain things become illegal overnight. And so I think that also creates a very difficult story.
And it is foreigners, isn't it, who have been the big sellers. They sold last week about $2.5 billion of A shares in the first quarter, about $27 billion. They seem to be the ones who are bailing out most of all.
Yeah, I mean, I think you had a lot of foreign investors that had sort of decided to take the risk and come back into China, regardless of, geopolitical concerns or anything else. They sort of said, listen, it's a big economy. We have to have a position there. We're going to be investing again. China's going to go in the right direction. And now those same foreigners, which were, I think, overall probably more bullish than a lot of domestic investors, are now saying, listen, we can't do this right now. We have to pull out and wait and see what happens over the next few months.
What is interesting is the difference between the Chinese consumer and the US consumer. The Chinese consumer seems quite downbeat. We had the data on Friday, the PCE data, which showed consumer spending in the US hit the highest level of the year. Now, presumably, that can't go on forever, particularly if the US hits a recession. So if the US consumer slows down, that's going to be another blow, isn't it, to the Chinese economy?
Absolutely. And I think the reality is the U.S. consumer now is starting to be stretched quite thin when you start looking at the persistent inflation. Even though the numbers have started coming back in the right direction, the reality is inflation is still an issue. We have very high interest rates, cost of borrowing for purchasing a home, extremely high. People can really feel the cost increases in the U.S. in their wallets. Now, if you throw in, for example, student loan repayments starting up again sometime soon, you start having a potential very big problem for the U.S. economy. So, and then because of that, a very big challenge for China. I think that we're going to find that the demand for Chinese goods does not bounce back the way a lot of Chinese manufacturers would like, though it will be interesting to see what happens with some of the tariff discussions that are about to be ongoing in the U.S.
So is this fully priced in, do you think, into Chinese equities, or is there worse to come then in that case, despite the falls that we've seen so far?
My guess is that people have probably tried to price it in, but I think that there are maybe a lot of people who are underestimating what a slowdown in the U.S. might look like, given how robust the economy has seemed to be to this point. But I could very much see the next couple of quarters in the U.S. getting fairly ugly from a consumption standpoint. So I would tend to err on the side of caution right now.
And what about the AI boom that we're seeing in overseas markets? There's almost like a frenzy, isn't there, at the moment in AI, particularly chip stocks, firms like NVIDIA, Taiwan Semiconductor, Advantest in Japan, all soaring. It looks like NVIDIA is going to become the first $1 trillion chip company. Are there equivalent stocks in China that investors could look at? Or is this unique to overseas?
I mean, it's somewhat unique to overseas only because right now, if anybody does true due diligence into the capabilities of these businesses, it's still really companies with an offshore presence, whether in Taiwan or a couple of other markets, that have access to the machines and the IP they need to make the types of chips that are most heavily used for application in AI. But I think at the same time, we are seeing a lot of interest now in the Chinese chip makers, and anybody that thinks they're not going to be moving very quickly to close the gap they now see themselves in would probably be wrong. So I think companies like SMIC should do very well, and I think we are seeing them starting to get quite a bit of interest from investors, whether or not they can actually support market demand right now or not.
But they're presumably a good couple of years behind, aren't they? Maybe more companies like NVIDIA and others.
Yeah, I mean, I think probably on the R&D side of things, the reality is they're still a few years behind, and on the production side of things as well, they are too. But what will be interesting to watch is I think a lot of the owners of underlying technology or chips that previously would have been selling to the Chinese market, whether end product or trying to sell to Chinese chip manufacturers, really would, all things being equal, rather be selling to the China market and would not like to be blocked out the way the U.S. is blocking them out. So I think one way or another, we're going to see technology migrate into China, and we're going to see these companies probably pick up a head of steam fairly quickly.
And interestingly, Jensen Huang, who's the founder of NVIDIA, the CEO, is in Taipei at the moment. He's been giving some speeches there. He's saying that this chip war is also going to do enormous damage to the US sort of tech industry. He's basically saying that what will happen is Chinese companies will just simply start to build their own chips to rival NVIDIA's, and therefore the US has got to be very careful. Does that make sense?
Yeah, I mean, I think if you look over a longer time horizon, that is absolutely going to happen. And I think that what the U.S. has done for a short-term gain has really pushed a lot of Chinese firms into action and sort of increased the amount of government support behind these initiatives as well. So you have a lot of smaller technology companies in China right now that have already started making fairly simple chips. And you're just going to see them ratchet up the complexity of what they're able to do over the next 1, 2, 3 years. And so I think it will be a lot less time than maybe some pundits think before China sort of reaches parity with the U.S. technology. That's the reality.
Is AI a big game changer? I've heard people compare this to like the invention of the smartphone or even the internet, that this is something that's going to be really transformative to the corporate landscape and also to valuations of some of these companies in the sectors. Do you see it that way?
I've spoken to more people in the past 2 months who have added AI into the name of their company or into what they say they're doing with their business development. And the reality is a lot of it is hype, and a lot of what people are calling AI in sort of fancy terms now, companies have been doing for years and years and years. And they're writing and refining algorithms that are running on big sets of data behind the scenes. And the answer is yes, the technology absolutely does have pretty interesting business applications, and it does make it easier to do business in various ways, and it will become more integrated. But I think there's a lot of hype and overstatement about what the capabilities actually are right now, and I think every year there has to be a new trend. Right now it's AI. Before it was NFTs. Before it was Bitcoin, and there'll be a new thing in another 6 to 8 months that people will start hanging their hats on. But yes, there will be interesting applications, and there will be some companies that do very interesting things.
You've given me a good idea about how to rename my company now. So I will stick an AI in it somewhere.
Turbocharge that valuation very quickly.
Indeed. Let me ask you finally about these discussions that are going on between Gina Raimondo, the US Secretary of Commerce, and Wang Wentao, who is her Chinese counterpart. Reason for optimism there? At least they're talking, aren't they?
Yeah, I mean, I would say yes, at least they're talking. It may be the case that nothing substantive goes on paper anytime soon, but I think just the fact that there is dialogue is extremely important given how frosty things have been. You know, the U.S. doing what it can to slow down certain sectors, and then China, being quite aggressive in the auditing of companies here. So I think it can only be seen as a good thing, even if nobody says any final agreement was made. It represents an openness to talk and an openness to trade, and I think that's what both economies and the world more broadly need right now.
And we mustn't forget, of course, that the Trump tariffs, the $370 billion worth of tariffs that President Trump imposed on Chinese goods, that they're still there, aren't they? So do you think there's any chance that they're going to get lifted soon?
They're still there, and it's interesting because I think, they're still being used as a political bargaining tool to some extent. And I think what the U.S. side has essentially said is we're not going to take these away unless it makes sense to do so economically. But also, conversely, we may not keep them in place if it doesn't make sense. So I think from the U.S. perspective, taking some of those tariffs away is great for relations, assuming that China give something back in return. But then also with inflation in the U.S. having been somewhat persistent, this is another way potentially to start bringing down consumer prices as well. So I wouldn't say that I'm optimistic that some of the tariffs get rolled back, but I think it's certainly in play right now that some of them do.
Ben, always very interesting to talk to you. Thank you very much indeed. That's Ben Cavender, who is Managing Director at the China Market Research Group. And thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian Fund Management Industry Consultant Stuart Aldcroft, Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, and Peter Kim, Managing Director and Investment Strategist at KB Securities. Bye for now.
Money Talk